Welcome back, everyone. We are live, and it is late Friday evening, probably gonna be Saturday by the time you see this. But I want to do an in depth look at the US economy and basically talk about what the recession means for you, how you're going to be able to actually recession proof yourself and your portfolio and your money, and everything you need to know about the upcoming recession because it will happen eventually. It is just a matter of when, and it's looking like likely by the end of this year and into 2023. That is according to most economists, CEOs, and economic experts. So you have to prepare for the recession. Super important. And let's do a quick little sound check on my end first, and then we'll get going here. Alrighty. We do sound good. Very good. And we have some people hopping on. Fantastic. Hello, hello, everyone. If you are first joining us, make sure you give this video a tremendous thumbs up, smash the like button. I would appreciate that. Just help the YouTube algorithm get the people going. And let us know where you're tuning in from, city, state, location in the live chat there or the comment section. And we will kick off this live in just a second. How is everyone going? Awesome, awesome. So yes, we're going to be discussing everything you need to know about the upcoming recession, how to prepare, what you need to know, what it means for you. Is your work in jeopardy? Is your job in jeopardy? Could you potentially be laid off? Are you going to see a dip in your portfolio? What are prices going to look like? Everything you need to know, we're going to be talking about in today's live. Super important information. Without further ado, let's get started and dive right in. But before we do, make sure you give this video a tremendous thumbs up. Number one. Number two, make sure you are subscribed and that notifications turned on. That bell will notify you every time we upload a brand new video or go live. And once we hit 20,000 subscribers, we will do another cash giveaway. And so you'll have to be subscribed to be entered in that giveaway. With that being said, let's get right down to it. So, number one, let's discuss what just happened this week, because that really is probably going to be the canary in the coal mine for the upcoming recession and what happened with the Federal Reserve. So, the Fed, if you didn't know already, just raised interest rates once more, this time by 0.75% or 75 basis points. And that is the most since 1994. This is, of course, amid the effort to slow down inflation and consumer demand. So, Fed raised on Wednesday 0.75%, largest move in a single meeting since the 90s. And the central bank messaged that further interest rate hikes will come this year. That is just as important as the rate hike itself, because once we have all these rate hikes and money and loans are just unaffordable by consumers and businesses, folks, the recession will come before you even know it, before you can even blink. So the Fed is leaning on higher borrowing costs to dampen the demand and it's trying to slow down the faster than expected inflation. According to the policy setting Federal Market Committee, they said in a statement, quote, overall economic activity appears to have picked up after edging down in the first quarter. They repeated its commitment to ongoing increases in rates. So the Fed decision lifts short-term borrowing costs to a target range between 1.5% and 1.75%. In economic projections that were released Wednesday, the median Fed policy maker expects to further raise interest rates to roughly 3.4% by the end of this year. In other words, more than double. And that would suggest another 1.75% in total rate hikes. This would be spread across the remaining four scheduled policy setting meetings coming this year. The Fed is now messaging a much steeper path of rate hikes than it had previously forecast in March, when the median number projected a year-end short-term rate closer to 1.9%. The urgency to move faster coincided with the Fed policymakers' expectations that inflation will not abate as fast as they expected in their March projections. The median Fed policymaker now expects prices to rise by 5.2% as measured by personal consumption expenditures, or PCE, over the course of 2022. This is a faster pace than the 4.3% it had forecast in March. So even the experts can't get this right. Even the Fed, no one could predict how fast this inflation is going, and no one really saw it coming. We're seeing numbers that we have not seen in decades. These are record-breaking numbers. If you look at the most recent inflation report, as we have reported, that is the highest rate of inflation since December of 1981, and it's really disastrous on people's wallets and financial situations, and that is why this recession could be coming with these rate hikes. So now let's discuss more specifically what these rate hikes mean for you and why this could actually then lead to a recession for those of you that don't quite understand the correlation between the two. As you might think, it has nothing to do with your job, it has nothing to do with your company that you work for, it has nothing to do with your money. In fact, it has a lot to do. In fact, it's directly correlated. So, the Federal Reserve is, of course, stepping up its war on inflation, and that means that borrowing costs are going to be sharply higher for families and businesses alike. The U.S. Central Bank increased the benchmark interest rate by three quarters of the percentage point on Wednesday, again, the biggest since 1994. So the fact that the Fed is moving decisively shows that confidence in the health of the job market, as far as the job market, looks pretty good right now. But with the speed of which interest rates are expected to go, underscores its growing concern about the soaring cost of living. High inflation, which are consumer prices, as we know, rose at the fastest pace in 40 years, will likely force the Fed to raise interest rates several more times in the coming months, and Fed officials may even resort to additional large rate increases in a bid to cool off inflation. Americans will initially experience these policy shifts through higher borrowing costs, and it is no longer insanely cheap to take out mortgages on or car loans. Cash sitting in bank accounts will finally earn something, but not much, and not nearly keep up with the rate of inflation. As if you want to put your money in the bank now, you're going to get 0.01%. Maybe that'll uptick a little bit, but the inflation and high costs will erode any gains whatsoever in your savings accounts. And you're going to need a whole lot of savings if you want to prepare for this recession. The Fed speeds up or slows down the economy by moving interest rates higher or lower. When the pandemic erupted, the Fed made it almost free to borrow in a bid to encourage spending by households and businesses. Personally, for myself, the first house that I bought as an investment property, of course, that interest rate looked like a steal compared to today's rates. At the time, I thought it was a high rate. Now that looks like a steal. I would do anything to get those rates back. I'm paying nearly, actually more than double, at least on my next property when it comes time to buy it. And it's just evident in everything you see when it comes to an auto loan, a mortgage, whether it's for an investment property or a primary residence, and businesses, if they want to access credit, if they want to access funding, or a small business, a big business, doesn't matter. You're seeing the rates, and it's more expensive to borrow money for anything. To further boost the COVID ravaged economy, the US Central Bank also printed trillions of dollars through a program known as quantitative easing, or QE. This also occurred right during 2008. The US did a whole lot of that, and it ultimately did work, although under the Obama administration, it was the slowest way we ever got out of recession in US history. So we finally got out of it. However, it was the slowest in history. When credit markets froze in March of 2020, emergency credit facilities to avoid a financial meltdown. The Fed's rescue worked. There was no COVID financial crisis. Vaccines and massive spending from Congress paved the way for a rapid recovery. However, its emergency actions and their delayed removal also contributed to today's overheated economy. With all that money in the economy, with all that money circling around in people's pockets, that led to extra demand. People had stimulus checks and were paid to stay home and not work. And all this extra money that was put into the economy leads to more consumer demand, which drove up prices. And that is why we are where we at today. Unemployment is good, though. It's currently close to a 50-year low, but inflation is very high. And those unemployment numbers, by the way, you have to take them with a grain of salt. Although they do look quite low and bode well, you have to remember that a lot of retirees now, people that shouldn't even be working, right? People in their 60s and 70s and even older than that, people that maybe are disabled and can't even really work, are being forced to work and get a second job or so just to be able to put food on the table. So, although the unemployment numbers look good, it has an insidious, behind the doors, behind the scenes, those unemployment numbers actually do not tell a very good story because a lot of seniors and elderly are back in the workforce after they haven't been for 20, 30 years, and they've been forced to work just to be able to eat and put food on the table and get their necessities and daily needs because their social security benefits and their fixed incomes are not necessarily helping them. The US economy no longer needs all that help from the Fed, and now the Fed is slowing down the economy by aggressively hiking interest rates. The risk is that if the Fed overdoes it, slowing the economy so much, that accidentally rather sparks a recession that then could drive up unemployment. Right. So this is because businesses will be forced to lay off their workers, and they won't be able. to keep up with how expensive it is to borrow money. And so, unfortunately, while you may have a very stable job right now, that job may not be with you and available by the end of this year or next year, depending on how the economy looks. Now, some argue that perhaps a recession may not come for a very long time, and in fact, the underlying U.S. economic numbers are actually very good. So there's certainly debate among economists. However, the overwhelming majority of economists and CEOs and experts do believe that a recession is coming. Check in here. Hello, hello. How is everyone going? Happy Friday, probably Saturday by the time you get to this. Hello, hello. Awesome to have you on. So here's how to actually recession proof your portfolio. What do you want to do? Where you want to allocate your money and your funds in order to be recession resistant? So many people probably have different opinions depending on who you ask, right? Someone more conservative may say to park it into something extra conservative in this fraught economic time. Now, if you ask me, I would certainly give you an opinion that you may or may not be able to implement just because it could have a high barrier of entry. So for me, most of my money, in fact, I would say 99% of my portfolio is in fact real estate. And during inflation, right, real estate investors and landlords actually like inflation because that would mean that costs go up, which means your value of your property goes up, and also rents tend to hike during recessions. So they tend to actually grow during a recession, whereas housing prices could potentially come down. However, if you look at rents over the course of recessions, if you look at rents during 2008 to 2010, they actually rose, whereas most people's incomes and finances took a dip. So if you are holding real estate right now, don't panic sell, hold on to it, and try to get the best rent that you can because there's going to be a lot of renters. We're already a nation of renters, but it's going to be even worse. People are going to be unable to afford homes, right? So your monthly housing payment that you had last year compared to now might be nearly double with the high interest rates, depending on what kind of rate you were able to lock in. So with that smaller pool of buyers and less people buying right now, you're going to see more inventory, and it's also going to be more demand for rentals. So if you are in fact in real estate, or maybe you just own your home, you might want to think about selling it, maybe downsize, and maybe use those extra funds if you want to hold on to them, and maybe buy an investment property on the side. That is certainly a viable option for you. But it is important to always stay diversified, right? So most people would opt for diversification, and so you might want to have some of your money in a savings account. You might want to try to get in now. There's probably more downside with the stock market, but relatively speaking, this could be a great opportunity to pick up some stocks at a really cheap discount and get in at a price that you may not be able to get in for your entire lifetime because of with how low the market has been tanking right now. If you're into crypto and you believe that Bitcoin is going to make a comeback and the crypto market in general, you might want to pick up some crypto. I'm not going to advocate for that. But if you are a crypto person and you want to have some of your portfolio in crypto, now could be a good time also to get in at a discount. There could be more downside. Obviously, everything carries risk. But perhaps in the next economic upswing, crypto can come back and Bitcoin might be able to come back a little bit. Will it go back to its peak? Who knows? But it certainly could make a comeback from here, as this is a pretty cheap price compared to where it was last year. You might want to have your money in bonds. You might want to have it in a CD. You might want to have some of it in maybe peer-to-peer lending. There's going to be a lot of people that are going to be taking out loans because they're going to be unable to afford anything, and so especially when they lose their job, they're going to have no stability with their income. So you might want to put some of your money into peer-to-peer lending. It does carry a risk. Some of them ultimately flop, but some of them do pay off. So you might want to diversify into that. You might want to put money into another business, start building that business. Now is a great time to start building a business and have that extra money coming in, especially if you end up losing your main income. If you build up a side hustle now, that could potentially pad you a little bit, maybe not save you completely, but it could potentially pad you and just be that extra enough where you could just survive another day and have another day to live. So definitely think about building that business now, building that side hustle, whatever it is. It could be a little side gig, or if you want it to be something to turn into a main source of income, start building that now, and that could require some upstart funds, right? It could require some initial investment, and you might want to put your money into that. So many ways to diversify your money, so many ways to be recession proof. Depends who you ask, but those are just my 2 cents in my opinion. So hope this video got some value for you. I don't want to drag it on too long, But do know that you'll have to be prepared for an economic downturn. And a lot of people were not prepared for COVID, but now we have actually some warning. We actually have some time to think about and evaluate our current situation. And it could be a good time to do something that your later self will then thank you for, because we have some time now before everything goes to absolutely nothing. So do know that a recession could be near, may not happen tomorrow, may not happen next month, but it is on the way. So I hope you enjoyed this video. I hope you got value out of it. If you did, give it a tremendous thumbs up, smash that like button, make sure you are subscribed and have notifications turned on. If you want to use my links down below, get some free stocks with Webull and Robinhood. Open up that brokerage account, start investing today, and get some free stocks, some value up to thousands of dollars. And if you want to connect with me on social media, I am on Instagram, I'm on Facebook. Use links down below and meet me there. And I look forward to seeing you guys in the next video. Take care for now.